Good day, I'm Chartered, your accounting tutor. In today's video and class, we are going to continue with financial statement of a sole trader. If you follow me up, you discover that in the previous video, we are looking at trading account, profit and loss account, the items that are used in trading account. The format was treated in the other class and video, while the items used in profit and loss account were also treated. In today's class, we are going to look at the third segment. I told that this profit and loss and other comprehensive income is divided into three segments. We already finished the format of trading account and that of profit and loss. Today we are looking at the last section, which is other comprehensive income. Most learners find it difficult to understand what is other comprehensive income. So like in a one-man business, it is not common. But it's good to understand all these technologies even at the beginning level so that we're able to get a sound grounding to enable you to have a safe journey in accounting. And that's why I want to take time and explain what we mean by other comprehensive income and how it is applied via the financial statements. What is other comprehensive income? Other comprehensive income refers to income, gains, losses, expenses, or valuation adjustments that are excluded from the ordinary net profit of the business, but are recognized separately in equity in the financial statement. When we talk of other comprehensive income, the business has what is called the ordinary cost of operation. That's what the business is getting on day-to-day, what the business is doing on day-to-day operation. So the income of sales, this can allow and other things that arise from the normal cost of the business are called the normal income. But other income also arise not from the normal cost of the business, but they also come in which the business have to accept and make use of it. That is what is referred to as other comprehensive income. And that's what we're talking about, the income that come from the gains. We're talking about losses because though it is called income, but losses can also be included. You don't talk of profit or loss. It is either profit or it's loss. So it can be gain or losses, expenses or valuation adjustment. That is, for example, if you have an item which is not meant for sale and you decide to value it up, then the assets that come from the surplus that come from the valuation of such assets is what is called other comprehensive income. Or if such an asset is being revalued downward and it results into reduction in the value of the business, it also refers to other losses. Let's look at examples of other comprehensive income as I explained. Number one, we talk of revaluation surplus of non-current assets. When we talk of revaluation surplus, what do you mean by revaluation? It's a situation whereby the assets or the business are either valued upward or in terms of value or downward. For example, a business have a building that today costs 10,000, costs 100,000 for instance. And then after 10 years, if the building is being revalued by estate value or any valuer and is taken to be 150,000, the estate value of 50,000 become what is called other comprehensive income, because the value of the building, total was 100,000 based on what is called historical cost concept. But as the building is valued higher, the difference that is added based on revaluation is what is called other comprehensive income. Then the next is fair value gain on investment. What is investment? This is purchase of shares and other investment in institution in terms of monetary. If you are able to buy shares in a company, in another company, and then if, for example, if you buy the share and the nominal value of a share, for instance, is 150 naira. As time passes over 2 to 3 years, if the value of the share is no more 150, but become 200 or 300, the difference that is added on the value of the shares you purchase become other comprehensive income. That is investment. Any investment, especially in shares or other money kept somewhere that's supposed to be attracting income. If the income increase over time, the increase in that income compared to what was acquired is referred to as other comprehensive income. The next one we have foreign currency translation gain or loss. Here too, we know that the value of naira and dollar sometimes changes as time passes. You can get a dollar value today at the cost of, let's say, 900 naira. As time passes, the same value of naira to dollar will now increase. Instead of getting the same dollar for 1,000, it becomes 1,500. But you already purchased the dollars and you kept somewhere. So as you come back to sell them, from 900 to 1,001, the difference between the value of the naira to dollar as you purchase them over time, as they are used in the transaction process, what is added based on what you acquire is also referred to as other comprehensive income. So the difference is the surplus. What is added that is referred to as revaluation surplus. There can also be a loss if the building is revalued downward. The difference that is reduced from the actual cost of the building also become losses. The same thing to fair value investment. If the value of shares that was bought 100 naira have now come back to become 60 or 70, the 30 or 40 become losses. The same thing to foreign translation. If the value of dollar to naira decide to reduce, what the business lost as a result of the reduction in the value of naira or dollar become what is called foreign translation losses. So now, let's quickly go to the format of profit or loss and other comprehensive income. This is the format. Mind you, in the previous video, we're able to, or class, we're able to present trading account and we're able to get net profits. After getting your net profit, the next thing is, it is a continuation. You are not to close it. Mind you, this is a continuation of the format of trading. You're not going to prepare them separately. By the time we finish, we're going to take a question that will join all these sessions into one. But this is just a continuation from the previous class. So this is your gross profit, which will be placed on the last naira sign. Mind you, the gross profit was realized from trading. Next, you have other comprehensive, other income. So this other income, all these headings you must underline because they are the key headings used in accounting. You must identify this so they will come out clear. Under other income, you have discount receipt, you have commission receipt and others. They now sum it and transfer it to be added to gross profit. If you add it to gross profit, it's supposed what they have called total income. But there's no need for you to just add it like that. Just leave it in that way to look more professional. Then the next, you go to the next heading, which is called operating expenses. Under operating expenses, I told you in the previous class that they are being grouped into headings. And the headings are three in number. Number one is what is called administrative expenses. These are expenses that occur directly from the administrative processes. Then number one is payment of salary. You put it on the first naira side. You bring out electricity. This is for us to know the group of expenses in the business. In case the business discover that the expenses are growing higher, they can control it, giving a particular section or looking at different sections that make the expenses to increase. So here, salary is under administrative expenses, electricity and others, as I gave the format in the items in the other class in detail to some extent. So if you add it, the total will be transferred here to become total administrative expenses on the second naira side. Next, you go to the next heading of expenses, which is called selling and distribution expenses. These are expenses that arise from the sale of goods. Number one, we have discount allowed. All should be placed on the first naira side to make the work come out very clear. Everything should be grouped according to its heading for easy tracing and monitoring. So bad debts, when you add them here, you transfer the total as the arrow is pointing to the second naira side. Last but not the least, you have what is called financial charges. These are expenses that will come from the business trying to finance its business by way of capital or any other way. So here we have things like interest on loan, bank charges and others. So they should be all arranged in the first naira side. Getting a total, you transfer it to the second naira side. From here, you now look at all these should not be shown just to guide learners to see how they will flow correctly. No need to point arrow in the real sense of it when you're solving it. But you now add the total of administrative expenses with that of the selling and displaying expenses to that of the financial charges. You get one total and then transfer it directly under the income, which is gross profit and other income. So as you can see, from here, it means you are trying to link the gross profit down to the end. So in accounting, any figure without bracket means addition. I'm still repeating. In accounting, any figure that is under a given figure and there's a line and you have to either sum or deduct, anyone without bracket means addition. So here it means we are going to add gross profit with to other income, and then coming down here, we are going to subtract it from the total operating expenses. It means this plus this minus this give us what is called the net profit or loss. It is net profit when the total gross profit, when the gross profit and other income it is higher than the total operating expenses, then you get net profit. The situation whereby the gross profit and other income is less than the total expenses, the result become net loss. Then after getting your net profit, if there is no other comprehensive income, this becomes the end of the story, where you close it, and this is the end of the business for the year to get the net profit. But if there is other comprehensive income, you have to create another heading called other comprehensive income. The other comprehensive income might already explain the building of the business was revalued, and the revaluation surplus was this amount. So if you take the building revaluation, which was the surplus, add it to net profit, the addition of this and this gives you what is called total comprehensive income. And this is the total comprehensive income. They now close it up, then that becomes the end of the profit or loss and other comprehensive income. Mind you, if you can see on the board, it is so professional if you are able to arrange all these items totally in this way. Most teachers, I must confess, feel that if they teach learners in this way at the beginning, they will find it difficult to understand or comprehend. But I want to still emphasize that if the format is being maintained in this way by learners from day one, from the beginning, and are able to understand it, as they move higher the journey of accounting, the whole story becomes so easy and straightforward. So I advise my learners to mind strictly the arrangement, not minding the picture of the whole thing looking as if it's complex. Not complex. It's just a matter of you trying to understand each heading and what is there for you to follow. So this is the best arrangement professionally accepted to arrange your profit or loss and other comprehensive income. Please don't forget to follow my video, like my what I'm doing, comment and share. If you have any question, please feel free to go down the comment section, ask your question. I will come back and address it in the way you want and give the best out of what you want. I remain your accounting tutor, Chartered. See you in the next class.